have 0.1% of Dave's net worth. I've been in business 40 years less than Mr. Ramsey. I'm an insurance professional. Last year we did just over 1.3 million in premiums for 24 clients, and I'm going to review this video.
Cynthia is with us in Charleston, South Carolina. Hi, Cynthia. How are you?
I have a question. I have, for a retirement account, I have an indexed universal life with a death benefit.
Mm-hmm.
Is that indexed universal life something you would keep?
No. And here's a simple thing. When you combine investing and life insurance together, the investments never perform like they should, and the insurance ends up being expensive because it's all wrapped together, and it's very hard to undo it unless you really know a lot about the business. It's very hard to take the two parts, the investment part and the insurance stuff apart, and look at them and go, wow, that sucks. Oh, that sucks. Oh, this thing double sucks. But I've been doing it for years, and so here's what it comes down to. The indexed investment is going into index funds. If you went straight to those mutual funds, you would make better rates of return because you wouldn't be paying extra fees that you're paying with the insurance product.
We'll pause there. A lot of this is on the right track. The first thing is we cannot call Index Universal Life Insurance that is maximum funded but below the MEC limit an investment. That is why it gets the tax treatment that it does, because it's still considered life insurance. So when he says there's an investing portion and a life insurance portion, it's kind of like a cash value account and then the life insurance portion, or the portion that's going towards the costs and fees. So he's on the right track there. And then the only thing I would say is when you are making gains in an index universal life, that is not happening by going into mutual funds. You're not investing in mutual funds. So he's a little bit off there. What's actually happening is you're getting credited interest and then using that interest to buy options, and then the insurance company, based on the performance of those options, credits you interest. So it can seem like investing in mutual funds, but you are not putting your money in the market. He also mentions taking them apart can be very difficult and knowing what's actually inside. He's definitely correct here. About 97% of these policies are not structured for maximum cash value. Most of them are structured, maybe it's 50% going towards the cash value, 50% towards the death benefit. Maybe it's less than that, and when that's the case, who cares what your rate of return is? Who cares what the tax benefits are if so much of it's going towards the cost of insurance and you're getting killed in fees? Like he says, if that's the case, why wouldn't you just put it in a mutual fund?
The insurance side of the product is what's called ART, annual renewable term. Life insurance, the older you get, it costs more to cover you because you're more likely to die statistically. Does that make sense? Every year it goes up based on your increased likelihood to die. That's pure insurance. Does that make sense to you?
Yeah.
15-year policies stay on the books a lot better than annual renewable term does. And so a 15-year on average over the 15 years is going to be not just the average, but it's going to be cheaper.
Yeah, no problems with this. He's correct thus far, although I do think I know where he's going with this. We'll continue.
Some of it's going to investing, some of it's going to insurance. But the portion that's going to insurance goes up every year. Therefore, the amount going to investments goes down every year.
So this is what I thought he would say. Because the annual renewable term is going up every year, because you are more likely to die every year, the cost per $1,000 of insurance is going to increase. That is correct. However, what Dave then goes on to say is because that's the case, therefore when you get older, you're paying more towards insurance. What he doesn't understand is that if you had, let's say, a $1 million death benefit and your cash value was $500,000, well, that $500,000 cash value is going to grow, hypothetically. So let's say it grows to $600,000. Well, now you are only paying for $400,000 worth of insurance. So your cost per $1,000 of insurance, of course, went up. However, the amounts of insurance that you're actually paying for decreases. So this is why that claim there about the more money you're putting in, the more that's going towards the cost of insurance, isn't correct in a properly structured policy. If you had an increasing death benefit and you kept that $500,000 worth of insurance that you're paying for throughout the policy, Dave is correct here, the insurance will continue to get more expensive as you get older. However, if you are structuring this policy for maximum cash value, you want to use it for retirement income tax-free, you want to use it to access for whatever reason, you're going to be paying for less insurance as the policy goes on. And there is different bands of insurance that once you reach a certain age, the amount of insurance the IRS allows you to have or requires you to have will go down. So once you hit age 95, for example, some companies won't even charge you for any cost of insurance. And there's lower bands below that as well, but just for an example.
You're better off to buy term insurance and do your investing straight into your 401k, into good mutual funds, or into your Roth IRA, into good mutual funds, without it being wrapped up and bundled up inside of an insurance product.
That is correct about the insurance on an annual renewable term being probably more expensive than it would be on a term because, like you said, the 15-year policies are going to stay on the books longer. They're going to get persistency credits. Those things perhaps are going to make the universal life more expensive as a whole when you sum all those premiums up that were just going towards the cost of insurance over the years. However, if for whatever reason you were keeping the same amount of insurance, which you shouldn't be, and you were trying to compare apples to apples, you also will get persistency bonuses with different index universal life policies, meaning you'll start getting credited bonuses for having the policy for 15 plus years, 16 plus years, depends on the company. And also, a lot of the time, if it's structured properly, those bonuses will not only cover, but exceed the cost of insurance, to where even though you still have a little bit of cost of insurance you need to pay for, the bonuses are completely covering that. However, when it does come to trying to use universal life or index universal life strictly for the insurance as opposed to term, I actually agree with Dave. In my own personal setup, I have an index universal life policy. I put money into that. It's structured completely for the maximum cash value. It's a very small amount of insurance for what I actually need to replace my income if I were to pass away to go to my fiance. However, I then have a term policy that's much larger than that, and that is for covering the main expenses that would need to be covered if I were to pass away. This more so is not for the insurance. It's nice that it's a benefit, but I'm using this for the tax benefits, for the protection from the market losses, the liquidity, and the other bonuses that might come along with that. I'm even fine admitting that other places like mutual funds perhaps will get a higher rate of return or have historically averaged higher rates of return. Most people who are doing index universal life are not doing it for the internal rate of return. That's not the main thing they care about. It's not just rate of return, where can I get the highest, but it's these other things that come along with it. And they realize that might not be the most important thing to them. That might not be what gives them the biggest peace of mind. Sure, you can coach them into saying, just put money in the market, hang in there, be mentally tough. Some people don't like that. And for those people, like myself, the index universal life has a lot of benefits there. And also, it's important to note, depending on the tax bracket that people are in, index universal life can have comparable rates of returns to those mutual funds when you take into account that when you access the money, that's happening tax-free. Also, you have benefits in terms of the withdrawal rates, being able to pull more out. Why? Because you have the floor, you don't have to worry about market losses. And if you're using indexed loans or participating loans, you have opportunity to earn an arbitrage on money you're taking out. All of these things kind of factor in, not saying one is better or one is worse, but these things are important to consider. Is universal life insurance a good idea? There you go, there's my review of the video. Leave a comment below, what are your thoughts? I will respond to each and every one of them. Look forward to seeing you in a future video. Bye-bye.